Hi, everybody. We're going to get started. Welcome back from lunch. I hope you enjoyed the morning and enjoyed getting to meet one another at lunch. So I have the distinct pleasure of introducing Dr. Ernest Chan. So I'm going to give you the bio, but then I have a quick story I wanted to tell about how I met Ernie. Dr. Ernest Chan is the managing member of QTS Capital Management, commodity pool operator. He began his career as a machine learning researcher at IBM's Human Languages Technologies Group, then later went to Morgan Stanley's data mining group. He was also a quant researcher and prop trader for Credit Suisse. He teaches a Master's of Science in Predictive Analytics program at Northwestern, and he is a PhD in theoretical physics from Cornell. I saved this to last because it leads into my story. So he is the author of several books, Machine Trading, Algorithmic Trading, and Quantitative Trading. I definitely recommend them all. And he runs a very popular financial blog at epchan.blogspot.com. My quick story, I quit my job and started Quantopian in the summer of 2011. And my first office was my backyard shed. And so I made a prototype. And I think I had 3 users, one of which was Jean Berdesh, my co-founder. And the third was like my wife. And I was trying to get feedback on the product, and I'd read all of Ernie's books, and I thought, well, I'll email him. Maybe, who knows, he might talk to me. So I sent him an email. I got a reply about 5 minutes later. Very very nice. So it'd be nice to meet you and take a look at what you're doing. And I gave my first demo of Quantopian to Ernie. He gave me a bunch of advice, told me a bunch of things I had done wrong. And the next morning, he wrote maybe 250 words on his blog about this funny little website, Quantopian. And so we went from 3 users to, and this was probably the most exciting, 3 hours of Quantopian for me. We went from 3 users to 100 users. And I thought, wow, this is just going to be so big. Because of that little bump, I then thought, well, maybe I can go out and raise some money and really build a company. So on the back of Ernie's 250-word blog post, Quantopian was funded, and basically that's how we ended up here. So thank you very, very much for your support over the years, and I think everybody enjoyed your talk.
Well, that's an amazing story, and it's. I'm so happy that it's grown to this scale right now. Honored to be here. Thanks again for us and everybody else for inviting me. So let me. Okay. So as you probably are aware, machine learning has been a very popular topic in these recent years. It has been applied to everything from facial recognition, speech recognition, playing Go, chess, and whatnot, and certainly has been applied to finance and trading in particular as well. But one problem, you might call, with machine learning is that it depends on a lot of training data, and in particular, it depends on stationary training data that has stable and stationary statistics. And unfortunately, financial data, as many of you would know, is anything but stable. We have a lot of regime changes in the financial markets. That might be due to regulatory changes. It might be due to macroeconomic changes. And I will discuss a few examples of that later on. But even if there were no external factors that affected these changes, anomalies, that is, market inefficiencies, arbitrage opportunities, would disappear all by themselves just due to competition. Right? It's, as in many businesses, when more people discover these opportunities, they tend to disappear. And this is self-induced non-stationarity there in the financial market. In contrast, if your machine learning algorithm is designed to recognize the faces of cats on YouTube video, the cats, they don't change their facial features in response to the fact that you have recognized them. So it's in that sense, much easier task. So let's look at some of the examples of these regime changes. One of the most famous example would be the 2001 decimalization of stock prices, for those who are old enough to remember that. Before 2001, the stock quotes in the US are quoted in 1/16 or 1/8 of a dollar. And after that, it was quoted as is now in cents. That causes a big impact on one very popular strategy, that is statistical arbitrage. And the reason for that is that with decimalization, the bid-ask spread become much narrower, so that it is a lot of times, it's much less profitable to make markets in stocks after that. And I have first-hand experience of that, because I was hired at that time in a hedge fund, which was quite profitable, 20 plus annualized return before 2001, and then suddenly the return did a nosedive after that to single-digit, return, and perhaps later on negative. So, and it affected a lot of setup funds at that time. Then the second, of course, most famous example of regime change would be the 2008 financial crisis. What happened is in the aftermath of the financial crisis, the Feds, of course, started quantitative easing, and that were designed to pump cash and liquidity into the financial markets, as well as other bigger part of the economy. But the side effect of that is that the market volatility has been greatly suppressed because of this quantitative easing. So a lot of the volatility trading strategies that worked very well prior to 2008, perhaps long vol strategy in particular, they just stopped working. And in contrast, all you need to do, the strategy that worked best after 2008 is simply to short vol. You just close your eyes and short implied volatility, and you will be making a great living after 2008, and it continues till today. It hasn't changed yet, that fact. So now, here's the problem for us. Okay, so we say, well, now that we identify 2008 as being the most recent regime change, let's just use the data after 2008 to train our model, whether it's a machine learning model or your favorite quantitative trading strategy that is not based on statistics. Anyway, we understand that we should use data after 2008. But the problem is, if your model is based on daily data set, there are only about 2,000 rows of data for training since 2008. In contrast, Google used about 10 million YouTube videos to train their neural networks for recognizing cats' faces. So that's a big difference in terms of the amount of data available. Now, that's not there are worse news than that. Okay, so seasonality would further limit the size of the data set. For example, if you're running an option expiration strategies, well, that rely on option expiring weekly or even monthly. Just having daily data doesn't help you very much, because the periodicity of your strategy is weekly. So you further reduce the actual amount of useful data to train your model. If you're running earnings strategies, well, unfortunately, earnings are released only quarterly. So again, having daily data doesn't help very much. It further compress, so your data is essentially, you only have 4 rows of data per year in that case. Even worse is certain seasonal physical commodity strategies that might trade only once a year. You buy corn or short natural gas or buy gasoline futures at a specific date or period of the year. Well, you get only one trade a year. So if you have 20 years of data, you get 20 data points essentially. So that is quite severe problem. Nobody can imagine that they can learn anything from 20 rows of data in a statistical learning context. So it might seem, from where I'm going, that okay, well, an obvious cure of the sparsity of data is just simply to use high frequency data. Don't use daily data. Use minute bars, use second bar, or maybe even using millisecond bars or whatnot. Well, there's an obvious problem with that. The problem is that a lot of arbitrage opportunities are sensitive to, are dependent on time scale. So you cannot run, it's not beneficial to supply minute bar data to a option exploration strategy because they don't expire every minute. So it doesn't really help you in increasing your data. And even if you're trading intraday, a lot of the strategies, and there are still seasonality intraday. So if your data is trained on the minute bars just after market open, might exhibit quite different parameters than if the model was run on the minute bars near the close or near the lunchtime. As you know, the volume exhibit a sort of a V-shaped pattern intraday. You have higher volume, much higher volume at the close and a somewhat higher volume in the beginning of the day at the market open and very low volume during lunchtime. So it's may not be useful actually to train your intraday trading model on the entire day's data, even if it's an intraday trading model. So actually the most obvious cure for this problem is not to use high frequency data, but to aggregate data from different instruments. For example, if you have a trading model that is applicable to stocks, well, make sure that it is the same model with the same parameters that can run on multiple stocks. For example, Russell 3000 stocks. So if, for example, you have 2,000 rows of daily data, and if the model is exactly identical to be applicable to be applied to every single stock, then all of a sudden you have 3,000 times 2,000 rows. You have 6 million data points instead of the original 2,000. So data aggregation is not just applicable to stocks. So a lot of futures traders, for example, insist on using exactly the same model that is applicable to every single futures market. So there may be 50 or 70, depending on if you count global futures market. And that's the way that they are able to get more data. It doesn't have to be just stocks. Any instruments, in any markets, whether it's futures or forex, you will probably be able to apply the same model on multiple instruments, and that's one of the easiest way to improve the statistical significance of your model. And that's, we'll see how effective that is in one of our trading strategy example later on. But beyond that very simple trick, which does, I would say 90% of the job, there are a number of techniques that we have, machine learners have developed over the years and which we can borrow. And we can borrow this whether or not our underlying strategy is really, quote unquote, for under machine learning. It could be any trading strategy that you created, or it could be a statistical trading strategy, it could be a machine learning strategy. These techniques are applicable to any of them, as long as your model requires fitting, as long as the parameters of your model need to be fitted using training data. So the first technique is called bagging. Bagging is essentially just oversampling existing data to create more data rows. You are artificially generating repeated data rows in a random manner. It's sampling with replacement. Okay. The second technique is called random subspace, and what we are doing now is instead of oversampling rows, we are undersampling columns. So if you imagine our training data as a table, the rows are the different data points. The columns are the different predictors. So bagging will create more rows, but random subspace essentially is going to reduce the number of columns, both of which are helpful in avoiding overfitting and increasing statistical significance. So that's the technique of random subspace. We are selecting a few predictors in a somewhat random manner to see what works well. Okay. If you combine, obviously the two techniques can be combined. Right? You can add both oversample rows and undersample columns. If you combine the two, it's called random forest. But of course, random forest has a very specific meaning in classification and regression tree, but the general method of combining bagging and random subspace can also be called random forest in general. And then the fourth technique is actually one of my favorite. It's very simple, but and it's very intuitive and it's very effective. It's called stepwise regression. Stepwise regression is you start from no predictor and you add one at a time provided that adding that one predictor increase some criteria such as maximum likelihood with penalty. Okay, so you have some penalty for being more complicated. You would penalize a complicated model, but at the same time, a more complicated model typically improve the maximum likelihood fit of that model to that data set. So there's a plus for being complicated, and there's a penalty for being complicated. So that's, you will add this predictor one at a time to your linear model until the criteria is maximized, and then you take them away one at a time. I will discuss that also in detail later on. But stepwise regression, just like random subspace, is a method for reducing the number of predictors. So it is, in order to improve statistical significance, you either increase your data set or you decrease your predictors. So this stepwise regression addresses the second method. So let's put this all together in a trading model and see how these different techniques play out. The model is a very simple linear regression model on S&P 500 stocks. It's a factor model. We try to predict the next quarter return. So you can see that here we have a variable, let's see, pointer. Okay. That is the quarterly return for the next quarter, T plus 1, for a particular stock S. And then we have a bunch of linear terms. These are our so-called factor loadings, and these are our factors. The factor loadings are things such as earning per share, dividend growth, and so forth. These are the numbers that you can extract from a quarterly financial statement published by the company. Now notice that these factor loadings, I call them factor loadings instead of factors, is because in financial literature, factor loadings are the ones that depend on the stock, and factors are the one in this case that does not depend on the stock. So the factor loadings depend on both the stock. Obviously, different stocks have different earnings per share, for example, and it also depends on time t, because obviously every quarter you're going to have a different earnings per share published by the company. So we have a whole bunch of these factor loadings that might represent earnings, might represent book value per share, might represent some other financial measure. And then they are multiplied by this thing called the factors. Now these factors are just basically regression coefficient. They are fixed. They are fixed not only in time, but they are also fixed per stock. So they are just a concrete fixed number that we want to discover, that we want to fit. So the whole objective of this simple exercise is a linear regression fit to find what the factors are, factor 1 to factor n. So now there's some constraints that we want to place on this factor model or this factor loadings. We only want to include factor loadings that do not scale with firm size. So we would not use, for example, revenue in dollars as a factor loading, because obviously, a Google will have a much bigger revenue than some micro-cap stock. So that would not work for this kind of factor model. We want to use factor loadings that are, for example, book-to-market ratio or the earnings growth rate. These are the numbers that are independent of firm size. And if you look through all the available data field in typical fundamental data sheet, you will find about 27 of these kind of factor loadings. And the source of these data, by the way, come from Schrader's core US fundamentals database, and it's available on Quanto.com. It's fairly inexpensive. It's certainly affordable to a independent trader. So here is the 26 factors. You will see familiar things like debt to equity ratio, share dilution ratio, price to book value, and so forth. So many of them are quarterly, and some of them, many others are trailing 1-year numbers. Okay, but the important thing is that even for the trailing 1-year numbers, they are updated every quarter. Right? They are not static. It's just happen to use the most recent 1-year financials to create that number. So, okay. We already have seen aggregation in action, right? I mentioned that data aggregation is the easiest and the most effective in overcoming the sparsity of data. And we have already seen that in action in this example. The reason is that we have assumed that all these factors are fixed for all stocks and for all time. So we are able to therefore combine the numbers for every stock in the S&P 500 universe into one data set and instantly multiply the amount of data by 500. So the training data for this model, I have set it to be 2007 to 2011. So how many data points there are? There's about 1,000 times 500 data points. So instead of just about 1,000, we have multiplied by 500. And so, okay, so we have a predictive model. We train this very simple linear regression model as a predictive model. What is the trading strategy out of this predictive model? Well, it's also very simple. At the end of each day, we will buy if the predicted return is greater than 0, and we will short if it's negative. And we will just hold that stock for 1 quarter. Now, you might think that, okay, before I show you the results, you might think that, okay, since these earnings come out only once a quarter, why do I have to do it every day? Why is this strategy run every day if the stock come out, the earnings report come out only quarterly? Well, that's because even though individual stocks, one stock have earnings come out only once a quarter, but on every day there's potentially some other stock that would have report earnings. They do not report earnings simultaneously, obviously. So every day there is potentially a new data row which contain a new information, new financial information from some stocks. Therefore, we have to run this model every day. And since our prediction is for a quarter return, that obviously we have to hold for a quarter. But if you do this, you might, of course, end up with about 60 position, let's say 60 long position in the same stock, because you keep buying. Every day the model predict that next quarter will be positive, you buy 1 unit of this stock. Next day the model make the same prediction, you buy another unit. So you have to be prepared that you might be entering into 3 months worth of this stock position. 3 months, each day in each month you are entering a new position. So this is the familiar term of pyramiding in trading. So you have to make sure that your buying power is divided by 60. So this is just a technicality, right? So this is true for any model where you run it every period and allow the new position to be formed. So you have to divide your buying power by 60 to allow for the fact that you might be pyramiding. Okay, so let's look at the returns. Now this is a out of sample performance. I have used the data up to 2011 to find the regression coefficient, and I have used that fixed model to make predictions out of sample from 2012 to 2014, and use that to buy and sell stock according to the simple trading strategy I outlined. And the result is quite surprisingly nice, for a model that is so simple, right? You have a return of 14.7%, Sharpe ratio of 1.8, and so forth. Without any particularly complicated rules, you generate a very decent model out of sample. So, and that mainly because we have done aggregation. If, for example, if you don't aggregate your data and you run a factor model on every stock, potentially with different regression coefficient, you will have 500 models, but also 500 times less data. You will find that the return will be much poorer because it completely overfitted the model in that case. Right? By aggregation, we have avoided overfitting, allowing this out-of-sample result to hold. So now let's go, try to improve this further by trying those 4 techniques that I mentioned earlier: bagging, random subspace, random forest, and stepwise regression. Again, bagging is oversampling a training set. If your training set originally had n rows, we will randomly pick those from those n rows with replacement. So with replacement means that you potentially could have picked the same row twice, 3 times, or even 4 times, whatever number of times. And you pick it n times to form what is called one bag. Okay, so this one bag is a resampled data set of the same size as the original data set. And you do that for k bags. You repeat this k times. So effectively, you have k times n data points. You artificially generate k times n data points. It is almost like simulation, right? In simulation, you're creating artificial data. Here, we are also creating artificially repeated data, except that these data are based on actual data. So after you created these k bags, you will train a model based on the data in each bag separately. You do not use all the bags. If you combine all the bags together, it doesn't work. You have to train a different model for each bag. So you ended up with k models. And finally, you take the average predicted return for the k models and use that for your trading strategy. Okay, so just a little bit of graphical illustration. These are data points, 1, 2, 3, 4 to n data points. This is the original data set. And maybe the first data point is sampled only once. It goes into the first bag. Perhaps the second data point is sampled twice during the formation of the kth bag, and so forth. The third data point was also chosen twice during the formation of the first bag. So these are all random, but they all ended up forming a new and a size n data set, but there are k of them. So this is just a illustration of exactly how this data selection process works. So, okay, that's good. Before I talk about the results, let me also explain in a bit of detail about the other, the second technique, which is random subspace. It selects a subset of the predictors. Okay, so it's very similar to bagging, except that this time you are sampling without replacement. So you don't want, because for linear models, you cannot possibly select the same predictor twice. It will cause collinearity problem. You will get a crash in your program if you select the two columns of identical values, right? So you cannot possibly oversample columns, oversample predictors. You have to undersample them. They have to be unique. So, but that doesn't present any problem. You just select, okay, so let's say originally you have m predictors. Right now, let's say I only wanted to have 3 predictors. You just randomly pick 3 and then form a model. And you pick another random 3 of them and form another model. So again, you form k models, and just like bagging, you take the average predicted returns of these k models as your final prediction and make your trade, feed that into your trading strategy. Okay, very simple. You can also combine, as I said, you can combine the two, and that's called random forest. Oversample data, undersample predictors. Just one little bit of a side remark is that when I said that you have to undersample predictor, that's only true in this particular example of a linear regression model. If you are using this, applying this technique to things such as classification and regression trees, you can indeed sample with replacement for even the predictors. Because in a classification and regression tree, there's no collinearity problem between different levels of the nodes. But that's a technicality. We don't need to dwell into that too much. So how does the result look with these other methods? It's apparent that, okay, so the first row is the base model with aggregation. We saw already it's generated 14.7% return. With bagging, with k equals 100, so you have 100 bags, it improves the return slightly, but it does nothing to the Sharpe ratio. Now, to a non-quant, okay, to a layman, for example, returns all that matters. But to a quant, Sharpe ratio is much more important. And the reason is that you can adjust your leverage to get any return you want. Even your model is terrible, okay, just generate maybe 2% return above risk-free rate. Well, you leverage 10 times, all of a sudden you become a 20% return model. So one should not get impressed by returns, is what I've been trying to tell my investors. One should be impressed by Sharpe ratio, because Sharpe ratio determines what's your risk-adjusted return. And in this case, you can see that Sharpe ratio doesn't get improved at all by applying bagging and applying random forest. So that's rather, you might think it's a rather disappointment, but there's a glass half full interpretation to that. So the glass half empty interpretation is obvious that, well, okay, all these fancy techniques doesn't improve anything, so why bother? But the glass half full interpretation is that, wait a minute, you have really tortured your data through this process of random forest or random subspace or bagging. You have really randomized it. You have done all you can to create noise in the data, repeating some rows, reducing the predictors, and so forth. The new data set that you feed into these algorithms look quite different from the original data set, and yet it has no effect on the trading strategy. That's something to be proud of, right? Because it indicates that really your trading strategy is quite robust with respect to perturbation. That's exactly what we meant by statistically significance of our backtest. The backtest is unaffected by randomization of your data in a, of course, in a controlled manner. You can throw random data into it, but you can randomly repeat data, randomly undersample predictors, and the trading model gives you practically the same result. That's something to behold. You should be proud of that if you are able to, have your trading backtest result unaffected by this process. So that's the glass half full argument. Okay, so finally we have the last technique, which is my favorite, which is the stepwise regression. In contrast to the random subspace method, stepwise regression is also trying to reduce the number of predictors, reduce the number of columns. But in contrast to the random subspace method, it is not doing this randomly. It is doing it in a very systematic manner. Okay, so stepwise regression will pick this predictor one by one, step by step, that's why it's called stepwise regression, based on a criteria called the BIC criteria. BIC is a statistical measure, which is essentially the maximum likelihood, the goodness of fit of this linear model on the data, penalized by a number that is proportional to the number of variables. In other words, if you have two variables, it will minus 2 times some number. If you have 3 variables, it will be the maximum likelihood minus 3 times some number. So you're trying to reduce the complexity of your model while rewarding the goodness of fit. So that's exactly what we want. When it's, in general, the more variables you pick, the better is your model fitting the training data. But at the same time, that will reduce its predictive power out of sample. So we want to penalize that. And BIC criteria is a standard statistical measure in any sort of statistical modeling. So we would, stepwise regression, use that as the criteria for which variable to pick. It wants to pick that variable that maximizes the log likelihood while not paying too much penalty in increasing the complexity of the model. So you pick it one at a time. You look through all the predictors in your pool, and you pick the one that increased the BIC, or actually it's negative decreases the BIC. BIC has a funny negative sign. So you pick one that decreases the BIC most. Okay, then you pick that, you put that in the model, and then you go look for another variable, another predictor in exactly the same way, one that minimizes the BIC on the second step. So you keep doing that until the BIC can no longer be decreased further. You might end up with 2 predictors in your linear regression. You might end up with 4. Who knows? BIC will determine that. But once you've reached that maximum number of variables or predictors, you backtrack. Okay, you will remove them one at a time. And the reason you need to do that backtracking, removing them one at a time, is because the stepwise regression is aggressive, it's a greedy strategy. Right? It's always trying to pick the one variable that minimizes BIC at that step. But it didn't try, okay, what if, sometimes in chess also, it is beneficial to sacrifice a move first in order to have a much more favorable move later. You might have to sacrifice a piece in order to have a much more beneficial move later. So, but stepwise regression is a greedy algorithm. It doesn't do that. So to compensate for this greediness, you want to backtrack.
So you start to go through all the predictors that you have added and select one that after removal, it might decrease the BIC. So it might actually simplify the model without much loss in the goodness of fit. And again, after you remove one, potentially, you try to remove another. So you might have gone from 0 to 4 predictors, and then you might go backtrack, and then you remove one predictor at a time, you might be down to 2 predictors. And removing further, the BIC criteria will not decrease, and you will stop there. So you might end up with 2 parameters that is not necessarily the global minima in BIC. It's not to say that this is the best combination of predictors that would give you the minimum BIC, but it's pretty good, right? Based on this kind of greedy search with retraction, that's pretty good already. And if you do that to our model, you will find that, again, the return is further improved. But again, the Sharpe ratio remain the same. It's amazing. OK, so you say, well, again, this method is wasted. What's the point of it? It does have a point, though, because feeding this data into the stepwise regression and give us only 2 variables. Of those 27 financial statement, financial variables, financial factors, the stepwise regression pick only 2. So the model is very, very parsimonious. And it's very intuitive because it tells you what's really important from a financial statement. And the 2 factors, the 2 factor loadings that this stepwise regression pick is gross margin, trading 1 year, and price to sales ratio, trading 1 year. So, I'm not a fundamental analyst, but perhaps, some of you who are certified financial analysts might, agree that these might be the most important numbers out of financial statement. I just want to mention that there's another method similar to stepwise regression called L1 regularization that also seek to minimize the number of regression coefficient. I haven't studied that, so I will just leave it as a side note, a footnote. Now, to sum up, one final word is that we have not imposed market neutrality on this model. So it could well be that the trading strategy we picked had a long bias, and therefore the return was benefiting from the bull market since 2008. What if it just keep buying every stock, right? Then it will have certainly a positive return, but that doesn't generate any alpha. So you can modify the trading strategy to make it market neutral by only buying the top 50 stocks with the top predicted returns and shorting the 50 stocks with the bottom predicted returns, and similarly hold 1 quarter. That way, you will ensure that your result is not because of it's not because of a beta, it's because of alpha. And it does turn out that, yes, the return is lower to 5%, but you still get the Sharpe ratio of 1.4. So that indicates that, yes, the alpha of this model is about 5.5%. Not as great as 14%, but still definitely statistically significant. OK, so let's just conclude. The key takeaway is that the simplest thing to do is to aggregate data. Add data from multiple instruments and apply the same model. That gives you pretty much 99% of what you want from these kind of techniques. But if it suits you, the second most effective method is to selectively reduce the number of variables using stepwise regression. That will cut down all these useless predictors that you think are useful to the minimal set. And that oftentimes give you a great much better intuitive understanding of what your data set is. It reduces complexity and improves intuition. So that's always beneficial in building a trading model. So with that, thanks very much, and I'm certainly happy to take questions. Yes. Yes, sir.
So, 2 questions. One is, how do you treat the sort of alpha decay problem of particular window you've trained the data on as you move forward an element of decay? Obviously, here you had a long sort of forward test, but assumptions at some point you had a look back period that kind of retrains the model going through the same process. And does that then, and the second part is you're rebalancing, given that it happens every day in terms of distribution of adjusting the positions. What's the impact of trading costs and just position stability in the
Yes.
portfolio?
The second point you make is easier to answer. I'll start with that. Yes, we do have to rebalance the portfolio every day because every day you're making a new prediction and you have to decide if you add to the position or eliminate it or just keep the original position or exit the position because it's finished their 1 quarter holding period. So this backtest does not include trading costs. Okay, so but fortunately, this backtest is on S&P 500 stocks, and we're only trading at the market close. It turns out that for S&P 500 stocks, the execution cost at the market close is quite small. It would not affect the outcome too much. So that's not a big concern here. But yes, in general, that would be a concern of rebalancing and transaction costs. The first problem is much more difficult. Okay. Now, I think you and I both attended a previous talk by Thomas on how to evolve parameters based on Bayesian updating. So there you go. That's one general method. But in this very simple example, we are trying to pick the smallest number of predictors, just 2, right? So hopefully, because of the simplicity of the model, it is much more immune to the shift in optimal parameter value. We are hoping that it is more robust, and it doesn't have to keep updating it. And that is borne out by the fact that fixing the training set and running it on an out-of-sample set, it seems to perform throughout 4 years in a walk-forward test without any change in the parameters. So that gives us some comfort that, okay, we don't need to get too fancy in updating the parameters all the time using walk-forward optimization or Bayesian updating and so forth. Yeah. Okay, I guess, go ahead, yeah.
I have a question about the bagging method. We know that many time series data are time dependent. The structure, they are not stationary. The structure may have some change or some structure within the evolution of time. So when run this resampling or bagging, did you consider that the structure when you do resample just randomly, will that break the structure of the time series data?
Not in this case, because in this case, our model is particularly simple, right? It's only depend on this quarter numbers to predict the next quarter. Now, if you have a time series model such that you would depend on, let's say, the last 2 quarters of numbers in order to predict the next quarter, then your data point will have to incorporate 2 quarters. So it's no problem what you described. In order not to destroy the time ordering of your data set, you only need to include all the dependence on the same row of data. So for example, not just 1 quarter, but last quarter return will be another column. Or not just 1 day return, but you might include 2 days return as yet another predictor in your data. So you have to preserve that structure that you know are necessary for your prediction. So that's one method. But if what you're thinking of is the problem of, again, that certain part of the data parameters are, the optimal parameters are different for the second part of the optimal parameter for the second part of data, but that's the same issue I just addressed. Hopefully it doesn't happen here and that was borne out basically by out-of-sample testing. Yeah. Okay.
Since the model ends up being so simple and only like two or three parameters, and it seems to be robust going forward for several years, you started out the talk saying we're going to only use data after 2008 because of, or between 2011 and I don't remember the range, but because of possible change. But then the model seems to end up being robust going forward. So did you try also doing a fit using data all the way back to like 2000, and the results also work even though there were changes?
Well, that's a good question, but I didn't do that. Yes. Yeah.
that's a good exercise, I would say. But I didn't do that. Yes.
And
Yeah.
one more, if you included as a factor the previous quarter's change, I'd imagine that would also be extremely predictive of the next quarter, because a stock is more likely to be similar to itself than also those other numbers. But I guess you'd also have a higher chance of overfitting, because that factor might be like too representative. Did you specifically choose to exclude something like that and keep it to things that were less likely to be tied to the return?
Well, I only tried the 0th order factors, right, which is the what they call it, the level, the actual number. But I did not include the derivative, the time derivative of the factors, which can be another factor.
But I didn't mean like the change in margin or the change in ratio. I meant the actual previous quarter return for this stuff. Like a moment.
Oh, okay. Right, so what you're saying is that in addition to these fundamental factors, you want to include technical factors such as...
But just one number, just the return, the change in price from the current quarter.
Right.
Just one number.
Just add one. Okay, yeah, I have not tried that, but certainly there's no reason to not try it. No reason not to, in fact, include other technical factors, volatility, whatever, that you can augment the fundamental data set. Yeah.
One more question.
Yes.
Yeah, I have a question. What, in practical terms, what would you say would be the minimum number of data points for these 4 methods to be applied?
Well, if you use stepwise regression, they will tell you. So that's the beauty about stepwise regression, is that if you just feed it 5 rows and 100 predictors, the stepwise regression will tell you that your BIC is too high. You can forget it. This model doesn't work. It will pick it will pick 0 predictors, right? On the other hand, if you give it 1,000 rows with the same predictors, it will pick one that has the lowest BIC. So that's nice that they will tell you. You don't have to worry about that. Yeah. Okay, thank you very much.